Hi everyone, welcome to another weekly Forex forecast for the week ending April 24th, 2020. My name is Justin Bennett with Daily Price Action, and in today's forecast we're going to discuss the EURUSD, the Pound USD, the dollar versus the Japanese yen, as well as the US dollar versus the New Zealand dollar, and we're going to wrap things up with gold or XAUUSD. There are two patterns in particular, one on the EURUSD and the other on the dollar yen that I want to show you that could lead to explosive moves over the coming months and perhaps even years. So let's get started right now. A quick disclaimer that today's video is for educational purposes only. All views are my opinion and are not intended as investment advice. Forex is a high reward, high risk business, and you should not trade with borrowed money or money you cannot afford to lose. See the description of this video for the full disclaimer. Before we get started, be sure to hit that subscribe button and also click the bell icon so you get notified every time I post these videos. Also check out the join button where you can become a member of this channel and receive 5 to 10 analysis videos from me every single week. I'll show you the key levels I'm watching and how I'm approaching that pair, so you'll get trade ideas from those videos, but you're also going to learn how I trade price action, and that's going to make you a better trader. So first up we have the EURUSD. And I spoke about this pattern last week to members in the videos. I also posted about it on the blog. And in my opinion, this is the pattern that traders need to keep an eye on with regard to the euro. So if you'll notice these 2000 lows, we have a trend line that extends from the 2000 lows. We then have this low and also these recent lows. The upper level extends from the 2008 high. We have this high that nearly touched the level. We have this one and also this one. So in my opinion, this is the most pivotal pattern for the EURUSD. In my opinion, I think that this pattern is going to dictate the future direction for the euro over the coming months and perhaps even the coming years. Because a break lower from this pattern could send the EURUSD down here to these lows, but more so down to all-time lows at 2000. Now I do realize that if you look at some of the other providers of data, this chart goes back to the 80s or even 70s. So some people have asked why I don't start with the 1985 low, and the truth is that this 2000 low is the euro's all-time low because anything before 1999 is all pre-euro trade-weighted data. So they took a basket of currencies prior to the euro's inception and came up with a pricing model to reflect the EURUSD price. So anything prior to 1999, this period right back here, is not actually the euro's price. It's pre-euro pricing. So this low, this 2000 low down here, is the euro's all-time low, and that level sits just below the 83-cent mark. Now, I personally think we're going to get a break lower instead of higher, and the reason I think so is, first of all, the New Zealand dollar versus the USD recently broke down from a multi-year trend line on its own. And if you'll notice, this pattern is very, very similar to what we're seeing on the EURUSD. The only difference is the New Zealand dollar has already broken down. So I talked about this breakdown actually on the blog, and we traded this for over 500 pips. Now, this trend line also extends from the 2000 low. We have the 2008 crisis low, and then we have some lows through this area. So the New Zealand dollar has broken down, and even though the EURUSD and NZDUSD don't share a lot of correlation at the moment, they do share the US dollar, and that does count for something, because if we see the USD start to strengthen across the board, that correlation between the two pairs does start to turn increasingly positive. So although this doesn't mean that the EURUSD will break lower, I do think that this breakdown on the New Zealand dollar could hint at a decline for the EURUSD. Furthermore, if we take a look at the euro's monthly time frame, and you'll notice how the pair has reacted to this support level, notice how the last 3 months have tested wedge support. So February, March, and April have all tested the bottom of this wedge. Now, the pair could still move higher from here because this isn't the first time we've seen multiple retests of a level. Notice back here that we had 2 months that tested support, and even up here we had a few months that tested resistance. So the EURUSD could still move higher off of this level, but the more pressure that the euro places on this support level, the more likely it is that we get a break lower. And that's because this is telling us that there is not enough buying pressure down here at this support level to drive prices higher. That theory could be proven wrong, but right now that's what I'm going with. So this is the pattern I'm really keeping an eye on over the coming weeks. As far as the intraday time frame, I talked about this last week on the blog, where we had this 4-hour rising wedge, and I was actually getting short up here at the top of this wedge anticipating a break lower. So I got short up here, which I announced in the membership site, and we can see where the pair then tested this short-term trend line from the year-to-date low. So we had a break below this wedge pattern, and then last week we got a break below this short-term trend line. Furthermore, you can see where the pair retested this level as resistance. So as of right now, the EURUSD is holding below this trend line, which signals that we could see a rotation lower this week into that 107 area, which is the bottom of that multi-year wedge pattern from the 2000 lows. Now, if we start to see the euro strengthen and close above this trend line, we could see another run at this swing high back here. But as long as the pair is carving these lower highs, and it's also staying below this short-term trend line, I'm going to stay short the euro and look for a move down here into 107. Of course, we are going to need a break below that multi-year wedge pattern in order to send the EURUSD much lower. And just based on the significance of this pattern, in my opinion, it's probably going to take a monthly close below this wedge support in order to confirm the breakdown here. Alternatively, don't discount the chance that we could see another run at wedge resistance all the way up here around 115, although my base case scenario right now is for a lower EURUSD. Next up, we have the British pound versus the US dollar. This segment will be much shorter than the EURUSD, and that's because we don't have a whole lot going on here, and we don't have a significant pattern to play like we have on the EURUSD, at least not one that I've come by yet. So as of right now, you can see where this 124.50 area is serving as support, and we also have the bottom of this channel that I mentioned the last 2 weeks, right around that 12600 area. So notice how this descending channel extends from these two lows, and last week topped out right around that 126 area. But the sell-off here did stall out around 124.50, and in my opinion, it's going to take a move below that area in order to send the pound lower toward 12200. But as of right now, I have no interest in trading the pound simply because we are just kind of caught in this sideways movement. And even though we've seen a rally from this all-time low down here at 114.50, there just isn't a lot of room to run. First of all, we have this resistance level here. We also have this 127.70 area, so that even if the pound USD does get above 12600, we still have 127.70 followed by the top of this descending channel just above that 127.70 area. So all in all, it's tight quarters for the pound USD, and that's why I don't have interest in trading it, because I like to get into trades where I have room to run and we also have momentum. And right now I'm just not seeing that from the GBPUSD. Next is the dollar yen, and this could be the most controversial chart and analysis that I've ever done in my career, or at least since I've had daily price action since 2014. And the reason I say that is not only do we have this wedge pattern, this multi-year wedge pattern that extends from some of these 2013 lows, and then we also have the top of this pattern from the 2015 highs. So I've talked about this pattern for a few months now, and in my opinion, just like the EURUSD, it's going to take a monthly close beyond this pattern in order to send the pair higher or lower. Now, one thing that you may notice right away from this monthly time frame is that there is a possibility that we have an inverse head and shoulders. So this red level up here would be the neckline. And I discussed this last week in the members forum where I talked about my longer term outlook for the dollar yen. So if this pattern plays out, we have a left shoulder over here, we have the head way down here at all-time lows, we then have the right shoulder back here. So this could very well be a 20-year inverse head and shoulders pattern that could play out over the next few years. And a close above the top of this wedge would make it more likely that we see another run at 124, which this 124 level is the neckline of this pattern. So the way I'm looking at this right now is I'm not saying that the dollar yen is headed much higher and that this pattern is going to play out. What I'm saying is that if we see the pair break above this wedge pattern, this inverse head and shoulders becomes more likely to play out. If we then see a run at 124 and a monthly close above that, then guess what? This inverse head and shoulders pattern would be confirmed at that point. Now, the measured objective, as you can imagine, for this pattern lies much higher, perhaps all the way up around 170. Now, just like the EURUSD, I'm not saying that this pair is going to move 5,000 or 6,000 pips within a matter of weeks or months or even a year. Patterns like this are going to take years to play out. Even this low down here, all the way up here to this high, took about 4 years. So this is a longer term outlook, and it's not to say that you should go buy the dollar yen and hold it for 4 years, but patterns like this give us a framework for whether or not we should be long or short on the daily and weekly timeframes. So this is just something to kind of set the framework for your long short bias. And in my opinion, if this pattern does start to play out, I only want to look to buy the dollar yen, whereas if we see the pair close a month below the bottom of this wedge, that would of course cause me to question the validity of this pattern. But one thing to keep in mind here is that the recent spike low reached a critical support level. So just around this 101 area, notice how many lows we've had over the last 20 or so years. We have this swing low back here, this one, we then have this high, this one kind of false broke below the level. We then have these highs, these lows, and then of course this last spike low just above 101. So this 101 area is incredibly important. So even if we get a close below this wedge support, it's still going to take a move below 101 in order to negate the possibility that this is a 20-year inverse head and shoulders. So now let's talk about what's happening on the daily time frame. And it becomes a little bit more obscure here because right now the dollar yen is caught in consolidation. We don't really have momentum one way or the other, and we had this recent sell-off, but then the dollar yen rallied off these lows, put in what looks like a V bottom, rallied almost back to this recent swing high, and ever since then we've just had consolidation. So as of right now, it's going to take either a move below 106.90 or above this recent swing high, which guess what, coincides with the top of that multi-year wedge just above the 109 area. So until we get a close above this area or below 106.90, we're going to see this consolidation continue. Now here's something else that's interesting that I want to leave you with. If we look at the 4-hour time frame, a case could be made that this is an inverse head and shoulders in and of itself. So notice how back here we had this swing low, which could be the left shoulder. We then had this sell-off and the V bottom, which I talked about. This could be the head, and then we have some of these recent lows. So this could be the right shoulder. So if we start to see the dollar yen strengthen over the next few weeks and take out this 109 area, and then also start to challenge some of these recent swing highs, it could really bring this potential inverse head and shoulders into the spotlight. So you could draw a trend line across these two swing highs to give yourself a neckline, which of course would confirm the pattern. But as of right now, I just think this is something to keep an eye on. I'm not saying that the dollar yen is going higher. I'm not saying that this pattern will play out, but it is something just to keep in the back of your mind if you are short the dollar yen. So again, in the short term, I think that 106.90 is the level that sellers have to break, while the area just above 109 is going to be the region that buyers have to break to send the pair higher. Next, we have the New Zealand dollar versus the USD. And I want to start with the monthly time frame because I did talk about this during the EURUSD segment, where we have a trend line that extends from the 2000 low. We then have the 2008 financial crisis low, as well as this recent one right here. Now the pair did recently close the month below this area, which means that the bottom of this wedge should start to serve as resistance. So if we drill down to the daily time frame, a lot of traders got faked out last week because they started to sell into this selling pressure. And in my opinion, the pair is still consolidating after coming off of this low back here. And whether or not Friday's session represents strength or it was simply profit taking before the weekend is something that we'll have to wait until Monday and Tuesday to see. But I do think that the New Zealand dollar is headed lower eventually. It's just a matter of timing our entries right so that we don't get faked out by moves like this on Friday. Now, a couple of levels to keep an eye on here include 60.50, which you can see recently has served as support and resistance. So notice how 60.50 back here served as support. It then flipped to resistance. It also served as support through here. And then on Friday, the pair caught some selling pressure right around 60.50. So if we see this area hold and the pair starts to rotate lower and takes out this short-term trend line, which could be the start of a rising wedge, that could send the New Zealand dollar lower. Alternatively, if we see the pair continue to push higher, it could take us up here to the 62 area that I've had my eye on for weeks. So this is a confluence of resistance where we have the bottom of that multi-year wedge. We also have a key horizontal level at 6,200, because notice here on the weekly time frame how 6,200 served as support back here, and then it did so just before the breakdown. So this 6,200 area is a massive confluence of resistance where, again, the bottom of the wedge, a key horizontal level, the top of this rising wedge, and it's also the top of this short-term descending channel. So the key here is going to be whether or not the New Zealand dollar starts to break below this short-term trend line, which could signal further weakness, or a move higher into 6,200, which again, in my opinion, would be a massive selling opportunity because it is a confluence of resistance based on several factors. And that could also send the pair much, much lower within this descending channel. Last but not least, we have gold, or XAUUSD. I've been talking about this one a lot in the members forums, where we've had buying opportunities since this area just above the 1600 level and also 1640. Now, I talked about this area at 1700 in the last two forecasts, and you can see where it served as resistance. However, Friday did close below that level, which indicates that we could see some further weakness this week, especially when you look at the weekly time frame, which did produce a bearish pin bar from this level. However, I wouldn't be one to sell gold up here simply because of this uptrend. So in my opinion, pullbacks like this are opportunities to buy at key support. Of course, you could look to sell a market like this, but you would be going against the grain. Furthermore, I think that this 1640/50 area is going to be a big one for gold this week. So notice how we have this trend line that extends from this high back here, as well as this recent one. And it's not as clear on this chart, but there was actually an inverse head and shoulders that formed on gold futures, which could signal a continuation pattern. And you can sort of see it here where we have this left shoulder, we have the head, and then we have a right shoulder. So where this neckline comes in is a little bit ambiguous, but I think that this 1650 to 1640 area could prove significant this week. So while we could see some immediate weakness this week from gold, I don't see it as a sell unless we start to see XAUUSD take out some of these levels and close below that 1640 area. If we do see that, the next key support would come in around 1550. Alternatively, if we see the pair recover back above 1690 to 1700, we could see an eventual run at the 1800 level that I mentioned the last 2 weeks, which would be the next key resistance level. But I do think that XAUUSD has to recover back above this 1690 area in order for that to happen. So resistance this week comes in at 1690 with support between 1650 and 1640. A close below that could take us back here toward 1550, while a recovery back above 1690 would expose the 1800 resistance area. If you enjoyed this video, give it a thumbs up, leave your comment below, and be sure to subscribe to my channel. See you next time.